Welcome back to another episode of Fund Friday, which will probably be changed the name of it to just LSCRE podcast channel, but more on that later. We've got a very special guest, and this is someone who, if you are a high earning professional and you want to follow a blueprint and you're younger, like the gentleman here, the co-founder of 7P Capital, Bryan Morris. How are you today? If you want to really follow a model and blueprint, this is a guy who should be a role model. Super stoked to have a conversation with you today. Bryan, coming out of the East Coast, how are you today, my friend?
I'm doing great, Craig. Thanks for having me. I've been looking forward to joining. I know we've known each other for a couple years now, and it's a pleasure to be on.
Yeah, well, as I said, I think you are the blueprint and the model for a high achiever in all realms of life, from your athletic background to crushing it into the real world, from a career path to kind of finding your way of investing and stuff. So I think it'd just be really great for you to share your story, how you got where you are today, and then we'll kind of unpack some questions between here and there, and then we'll talk about your strategy moving forward.
Absolutely. I appreciate the kind words. And I can go back really to when I graduated college. I knew I wanted to go to college for business, but it was very much broad, right? Business management, business administration. Always kind of had an entrepreneurial mindset, but didn't really know what that was going to be. And so went to school, graduated with an offer from Pepsi, Fortune 50 company, was excited, stoked, $50,000 salary. I was like, man, I made it. This is the most I'll ever make. Because, you work your jobs throughout high school and here making, your hourly rate, but first time salary, I thought I was crushing it. And
Benefits.
so did everything. I was like, man, this is awesome. So fast forward, a couple months and I pick up Rich Dad Poor Dad, trying to do some financial literacy and figure out, what a 401k was even, right? Graduating college and how to start my retirement and really just be financially savvy. And after reading that book, just a couple months out of college, it really put a completely different perspective into what I wanted to focus on and what was important to me. Luckily, at a young age, I picked it up. I was 22, going on to 23 here shortly after in a few months. And I remember texting my mom. I was living in Harrisburg at the time, and I was like, I really want to buy a rental property. This book just kind of changed my whole perspective on finances and retirement. And fast forward 6 months, I was closing on my first pre-foreclosure $88,000 single family 3 bedroom 2 bath unit in my hometown of Bethlehem, Pennsylvania. And it was scrappy to get that closed. I luckily over the 12 months I started working for Pepsi had $17,000 saved. So just enough to get the closing done on that house. But that's really what started my journey. So it wasn't necessarily that flashy, but it was an important first step to get me into the real estate industry and into the game of rental properties.
Yeah, well, it's funny. Real estate's really not a flashy job. Now, of the flashy components to it, I would say now you're on the flashier side of things, as am I. But every single time I go to Houston, I'm reminded about the hard work and the nitty-gritty human dynamics that this job really does take. From those when you're trying to compete with other, kind of companies, properties to get good talent where they're basically all paying the same. How do you convey your value? How do you do this? How do you do that? How do you keep people happy? And such like that on pretty razor thin margins, and it's not sexy. Apartment complexes, owning them sounds really cool, but managing them is actually really challenging and tumultuous. So I can appreciate that, and your candid honesty there is awesome. But the benefits are the sexy part, and what you make of it and kind of incrementally growing is the sexy part. So from there, you started with that property, and then what was the kind of the graduation up from that? How would you kind of could you talk about your career progression from there to now as well, from Pepsi, and then also kind of your investment window as well, how that kind of evolved and changed over time?
For sure. Yeah. And you hit it spot on, right? The whole passive income, quote unquote, is the sexy, flashy term nowadays. But, after you close on a property, that's when all the work begins, the operational job that, entails to running a property. And, fast forward after that, we did the Burr method, which, is the buy, renovate, rent, refinance, repeat, right? The single family way to go about it. And I bought a 3 unit property after I refinanced that about 10 months later. And it was after I bought that 3 unit that I realized economies of scale, more units under one roof. And I was like, all right, I'm sold. Multifamily is the way to go. Why can, buy 3? Why not 10? Why not 50? And so that was over the course of my first couple of years. This was 2016, 2017. So, in hindsight, it was a great time to buy. Interest rates at 3.8, fixed 30-year mortgages, appreciation has skyrocketed, cash flows on both those properties have skyrocketed. But it was, a few months after that I got the offer in New York City to move from Bethlehem, Pennsylvania, where I'm from, to New York City. And so I was still looking around Bethlehem at the time after I bought those two properties initially, but it became a little bit more difficult to manage from a couple, states away. Luckily, my parents are still there, so they keep a close eye on the properties. And obviously, I go home every couple months. Only a 2-hour drive, but my my process and my strategy then began to shift once I started to uncover what was multifamilication and what is multifamily syndication and the process of more commercial real estate and the scalability of that. And so that's when I really started to dig into education, furthering understanding, underwriting, right? How to finance these properties, looking at an Excel model, an underwriting model, and determining entry cap rate, exit cap rate. There's so many components to understanding this investment, which was important for me to understand prior to making my first investment into, that next piece of the puzzle, which was that commercial real estate space. And so coming to New York, I wanted to escalate my W-2 earnings, so I transferred from, Pepsi to another employer, Cintas, and now at Salesforce. So I got into the tech space where I wanted to be and really at escalating my earnings. And I wanted to take those earnings and started to diversify those into real estate because I know how powerful that could have been. And, from 2018 to really when we started 7P Capital in 2023, it was an education journey. I went to the University of Penn Wharton, real estate analysis course, certificate there, and then also got into my own investments to understand really under the hood of these type of investments to educate myself first and put my money to work and see, what avenues I liked. And, 2023 is when we really started 7P Capital because I knew the power of not only commercial real estate, but helping others, throughout my journey and my education and what I had to offer, do the same who, were in the same position I was, 6, 7 years ago.
I love that. And it's really cool that you really did study, you took your time, you applied, kind of the information that you learned from such a prestigious institution with the real estate backing, coupled with your own experience of, doing it yourself to kind of marry everything together, which honestly just gives you so much credibility in the space. I really tip the cap to you for being such an achiever and winner and taking the right steps and, really not taking a shortcut here to kind of go into this thoroughly and methodically. But the beautiful thing, which I want to switch gears to, was that you were obviously getting paid along the way and just kind of enriching yourself with kind of what you were doing with, all the other corporations then to Salesforce. So I have to imagine your avatar, which for those who don't know what an avatar is, it's basically someone that you raise money from. That is someone that is your dream investor, if you will. I have to imagine people that you're typically raising from above and beyond your friends and family and referrals are probably people who were very successful earners in the tech sales space. Is that fair to say?
You are spot on.
Yeah.
I think of it as the person I was 6, 7 years ago who is doing very well in their job, but they have a demanding W-2 job, right? Oftentimes these, very qualified, highly successful tech sales employees are in San Francisco, New York, Chicago, Miami, not typical markets where you can go out in your backyard and, even find a 3 or 4 unit or your own rental property
Or your
that
own
easily. So
or you're even primary residence and you just want to get some real estate
that's
exposure.
that's it. And it makes it very difficult because a lot of times they're stuck, right? Now they're flushed with cash over a successful few years within tech. And they're like, I want to get into real estate, but I don't know how. And so I either just throw it in the market or I'm overly weighted on my company stock, right? A lot of times you get RSUs or employee stock purchase programs or different incentives within these companies to incentivize stock, which is great. And, but I don't think you should be overly weighted within not only the company that you're relying on for your income and your benefits, but also very heavily weighted within your portfolio. And so I talk to people all the time that are looking to diversify. They understand the importance of real estate, tangible asset that, offers a lot of benefits, outside of cash flow, but also depreciation and everything that can go into these type of investments. And that's where we kind of help come into play and introduce them to opportunities, markets, assets we're investing in, different operators we partner with. And that's kind of the avatar that we speak to.
Yeah, and I really think that your background and pedigree serves so many people and is such a relatable one. If you are, heavily involved in tech sales, if you're a high performer, you can make a lot of money, and you also might have what's called maybe awkward amounts of money where you get 50K, you get 100 grand, you get $150,000 bonus, and it's a lot of money, but it may be not enough to level up, your primary residence, but you want to put it somewhere perhaps outside, above and beyond what the S&P 500 market options excuse me. So this is why the syndication spot and the route that you're taking is so great, because it's not a all or nothing game here. I think the big thing you talk about is diversifying and diversification. I have about just as much dollars, admittedly, in the stock market as I do in syndication deals. So I want to be very clear here. Those are good options, but it's not an either or. It's a this and I really love that you kind of come with that perspective there, where you don't want to put all your eggs in that basket there. And when you do talk to these tech individuals, I mean, what's kind of the common bottleneck and kind of pain points that they have with regard to kind of their day to day and the things that you solve for them? Is it just basically helping them kind of figure out their next steps? Because so many individuals, whether you're selling homes or you're in the tech world there, if you will, you might be a really successful earner, but that does not make you a very good investor or financially literate, right?
Yeah, spot on. And I completely agree with the diversification. You know, typically when I have an intro conversation with an investor that comes in, as a lead or reaches out, it's really the first question is two things: is do you want to be an active investor or do you want to be a passive investor? Right? Because many times they come to me and say, "Hey, can you help me buy a single family house? Can we invest in a 3 unit?" They might not understand necessarily how I can help, and that's why I'm more than happy to have a conversation with anyone interested that's looking to invest in real estate. But then it's like, where are you living and how much time do you have in your hands, right? Many of the time, most of the time, these people are working 40 plus hours a week. They have a family, a wife and kids, right? They don't want to spend every other waking hour trying to find a market, find a deal, manage tenants, be a landlord, etc. And so that's kind of where this piece of the puzzle really comes into play nicely, because they can get into institutional quality assets with operators that are managing these day in and day out, doing the heavy lifting. And our job is to ultimately do the due diligence and build those relationships with operators in really strong markets that are getting really strong assets under contract and understanding the business plan. And to go back to your point earlier, and my education journey really between that 2018 to 2023 of investing in my own deals and understanding the ins and outs of commercial real estate is, every deal looks great in the PowerPoint, right? That comes out and it says, "Hey, this is our deal," and every single operator can make a PowerPoint look phenomenal. But you really want to dive in under the hood and understand how are you getting to those assumptions and how aggressive are they, to really understand the investment avenue. And so once they decide, active may not be the way they want to go and passive is the way, I really send them some collateral, send them some stuff to study, read over, start to familiarize yourself with some of this terminology, right? Net operating income, cap rate, IRR, right? Just flashy words, essentially, that at the end of the day is pretty easy to understand if you just, these are a lot of really smart people, very successful in what they do, and they just don't want to spend too much time in understanding, the management aspect. But really good opportunities to invest, and that's where it starts. And then after, a few weeks and a couple months of talking and working with these individuals, they're like, these investments are awesome, right? Risk mitigated with a really strong asset and ways that we could really invest into something that's delivering some cash flow now, but also growing, that wealth and the appreciation and equity along the way.
Yeah, it makes so much sense. And what I really like too is just, as I said, how methodical you work. Because so many people get into stuff right away, kind of half baked, but you have taken the route, which I'm sure was paining for you because you like to do things quickly, like I do. Maybe
Yeah.
sometimes too quickly for my own good. But you went through it and were thorough about it. And, I have to imagine a lot of your investors too that you're looking at, probably love the idea where if you're in a kind of a stressful sales job, to build up and stack annually investments. It might not sound like a lot today, but $200 a month here, $300 a month there. Over the course of time, if you kind of keep adding to that, it will create a very, very big ripple and wave where you're making maybe now a couple $1,000s a month passively, right? And I imagine for a lot of high successful sales earners that might have some, volatility with relation to commissions and stuff, something like this might sound really appealing to have stable, consistent, and reliable cash flows. Is that fair to say? That's something that they're typically looking to solve for?
Spot on. Yeah. And to go back to your point about diversification, another topic that we normally talk about is you mentioned large commission checks. They're common in, tech sales. You might have a really big quarter where you get a 6-figure commission check. And I'll often tell people, hey, you have $250,000 to invest. I would recommend actually putting that 250,000 likely into 5 different deals at $50,000. Now that might not be what you typically hear from an operator or from even a fund manager, but I'm looking out for your best interest because I still think diversification in different markets, different operators, and different assets can really go a long way. So if you get into, say, 3 deals in 2025 that you feel very strongly about, and you get into 3 more deals in 2026, each deal has a different business plan, a different model, likely is going to go full cycle at a different time. And so if you start stacking those deals upon each other, right, you talk about, yeah, a couple $100 here, a couple $100 there per deal per month in cash flow. It's not going to make you walk away from your W-2 job just yet. But what it will start to do is start to build and compound on itself. And so when you start getting, maybe one goes full cycle in year 3 or year 4, and then you start to get a windfall of profits, right? And then you reinvest those profits and you have depreciation that's rolling over. That's when it starts to become really powerful. It's a snowball effect. And so the more assets, the more diversification that you can start to spread this capital out, you really start to compound that. And, I also say and recommend, the reason I recommend, that 250 over across 5 deals is a lot of deals you're going to see in the space are going to have an IRR anywhere between 14 to 18%, right? It's very similar along a lot of the projections, but one deal might finish at a 10% because it was a little bit of a tougher market, a little bit of a tougher time. One deal might knock it out of the park at 25, right? If you put all your capital in a deal that, slightly underperforms, quite frankly, you missed out on a deal that drastically overperformed. And again, you want to diversify and you want to have those risk mitigation strategies. And I think that's a really good way to go about it if you're looking at the capital that you're looking to deploy.
I have so much to say on this topic, and I really love that you said it. And this is probably why, holistically, you and Chris and I and the team get along so well because we fully believe and buy into exactly what you're saying. So, first story I have is a very nice lady who will be investing with us for the first time asked me, like, "Hey, I have $200,000. I have 100 invested with you guys. I was thinking about putting more." And I was like, "Well, to be honest with you, we have another deal coming up behind this. And this legitimately happened like 2 weeks ago. I was like, we have another deal behind this. I would honestly just, I think I like this one more than the current deal coming up behind it, but I don't know what deal is going to be better because, quite frankly, other members on the team like the next deal more. So I don't know, for whatever it's worth, what deal will do better or not. But what I can tell you is kind of spreading across 2 deals could really potentially protect you. We don't know where the outcomes of that's going to be. So instead of going all in on one, I'm not a fortune teller, unfortunately. I don't have a crystal ball that works, but if I did, I may not be doing this conversation with you today, with all due respect. But if it had it, and if you had it, you wouldn't be here either. But we don't know where that's going to go. So I would just really and thoroughly recommend you, probably put your dollars in, this deal. And then if you want to allocate more dollars to Lone Star, why don't you allocate it into the next deal? And then she also asked me, she's like, yeah, I'm looking at another deal in Houston. I'm like, hey, listen, you're a smart person. I'm not going to talk you out of that. I think that's great. Go forward with that. So I think it's so smart to do. And then similarly, just to the theme of, stacking things up, so many people were making so much money during the ZERP environment. ZERP is zero interest rate period. Brian, you're probably laughing at this because you know what it was like selling deals when there was literally like free money. Everything was grow, grow, grow.
Yep.
Cash flows went out the window. It was all about growth and equity multiples and stuff like that. Whether you're in an EBITDA business or a cap rate business, people really threw fundamentals out the window. They could get financing, right? Well, what also happened is a lot of people over consolidated their dollar cost averaging and allocations into the market in 2021 and 2022 when the deals were the frothiest was also when the market was the frothiest is when deals are unfortunately the worst from a timing perspective. So if that individual investor just instead of going all in on a couple of years span, but actually just drug it out between a couple of years, they'd be way better off and probably more encouraged to stay in it. But a lot of people are going to get wiped out by that. So I really love the sentiment you have there. And also just, the idea of diversifying there just makes a lot of sense. People always ask me, oh, well, what do you like about this deal? What else is coming? And I'll always give you an honest answer because we don't need to oversell and to kind of coerce people into our offerings, nor do you. We want to attract people into our deals and have there be legitimate buy-in where we actually have a good relationship with our investors, but also we have a good relationship kind of with the man above where, hey, we don't have to be doing anything gimmicky or salesy in order for us to mutually win together. And it's all about when the client and the investor is ready. But just to double click on those points there, as you mentioned, I really appreciate your perspective there to not get overzealous and hyperbolic about something and just stay the course and dollar cost average in. I mean, it is just remarkable the patience you have. And anyone, just a PSA for any capital raiser or any investor, if someone is saying this is the best deal of all time or is getting super hyperbolic, you should probably run away from that. And then also to your point, if a deal seems too good to be true, like an outsized market projected return, it's probably a scam of some way or another, or some financial modeling engineering, because these deals are hyper competitive. There are no secrets in big markets. Every seller has a fiduciary duty to get the highest and best price for their investors. So no one's just giving away deals on a gifted basis, if you will. And unfortunately, marketing and sales, as Brian and I probably work and on the side, on the right side of this, but marketing and sales actually works, and people work you down. So you want to make sure you're with people that are ethical and reasonable, where you're not getting talked into something you think is inappropriate, or that looks super sexy without realizing the risk associated.
I completely agree. Yeah, you hit a spot on too with the whole dollar cost averaging, and it's the same concept as what you hear in the market, right? The public market. And to your point, I still have exposure to the public market. I still think as a whole portfolio, right? I still have my 401k working at Salesforce. I still have some employee stock purchase program and shares within Salesforce, but a lot of my liquid cash that I want to work with and manage is tied up into different real estate deals, whether it's my own personal portfolio or passively investing with operators and through 7P Capital.
Yeah, so unfortunately, we don't have your partner on Chris, who's the man. See you soon, Chris, in New York City
Yeah.
at the Lone Star Capital Summit event on September 14th to 15th. Get your tickets, apply online if you haven't done so already. So super stoked that we got to talk, Brian, about your kind of background, your pedigree, and kind of who you raised from, who you're looking to raise from. Not that it just limited to that, but would love to learn more about yourself, and obviously what your partner Chris does. Chris is from the UK. He's got a charming British accent, but please dive into kind of your strategy, what you're looking for out of a deal, and then also, arguably more importantly than the deal, the sponsor and the person you place capital with.
Yeah, it's a great question. And arguably that last point is the most important, is who you're partnering with. But the really the thesis of us starting 7P Capital was we were investing in these deals ourselves, and I had owned real estate myself personally since 2016, and I saw the power behind it, not only through the appreciation and the equity growth, depreciation and tax write-offs, right, that come along with direct ownership, as well as that cash flow that it's giving me every single month owning my own rental properties. And so then doing due diligence and education into commercial space, learning this was really the caveat to us starting 7P Capital in 2023. And our whole basis of this 7P Capital business is we want to offer and be fully transparent to every single investor that we speak to about what options are out there to invest in commercial real estate. Because one, I have conversations with probably 15 to 18 new investors every single week. I would say 90% of them don't even realize that they can invest in commercial real estate today. So that's the first hurdle, right? It's like they only think that the only way that they can invest in real estate is if they buy a rental property or a small property themselves, which is quite overwhelming based on the what we talked about earlier, the markets they live in and the job that they do week to week. And so introducing that aspect to them. And so introducing what 7P Capital can do is we build and do all the due diligence, build relationships with operators in different markets, different asset classes. Now, we primarily focus on multifamily today. It's what we know the best. We feel like the asset class from a recession resistance is the best asset class to be in because people need roof over their head, right? We have a drastic shortage in supply from a housing standpoint within the market, right? That spread between direct home ownership to renting is becoming larger and larger every single year, quite frankly, after COVID. And you're seeing some of these, markets that have just been skyrocketing after COVID. And, rental growth was sometimes 15 to 20% in some of these markets. And now they've come back down to earth and, they've kind of stabilized a little bit. But my point being, I think multifamily is a really good avenue and a really good investment long term, even if it's going through a bit of a tough time right now over the last couple of years after the interest rate spikes. But we really have an investment strategy that's two-armed approach. One being the multifamily equity approach, which is the common equity investor. And so what that typically means is everyone knows that there's a loan in a bank. So if you're buying a $10 million property, you might get $7 million loan on that property, 70%. And then with a 30% down payment. So $3 million that's raised from investors. And then you'd raise a little bit more from capital reserves, capex, and what the bank requires from a reserve standpoint. So we would typically be equity investors within that investment, and so we'll see the upside of any equity gain, growth of the property, and when we sell the property in 3 to 7 years, right, we see the potential upside within that property. If we sell it for 20 million, right, and bought it for 10, then we could see the upside in the equity as well as cash flow along the way. Our other side would be a private credit side where we essentially acting as the bank. Now we're lending out capital within a fund across multiple commercial loans, and we partner to lend out those as well. So those are really the two strategies. There's pros and cons to each, right? On the equity side, you get the depreciation, all the tax benefits that come along with it, and the upside growth. The credit side, you're really just getting interest income, and that's a tax liability at the end of the year, which can take away a little bit from your return. So we really want to offer a two-pronged approach to those investors, and it's really just based on your preference and where you are within your investing career and your journey. If you're looking for stronger cash flows, sometimes a private credit, more consistent fixed income makes more sense, more flexible. But if you're looking for upside growth and long-term equity, then I often recommend multifamily investments and equity plays for long-term, capital appreciation as well as capital preservation.
And then what are some of the markets that you're looking at for either side of the aisle on the private credit side of things or also the multifamily housing side of things?
Yeah, and so multifamily housing, typically we see a lot of deals come from Texas. I know you guys primarily focus in Houston and Dallas, right? It's very strong market, very competitive. I know you guys are, very much you own a ton of units in Houston, which you guys do a very nice job there in that market, which is why we love, partnering with you guys and seeing what you guys have coming through the pipe. From a private credit standpoint, it's really diversified through many different states. Currently, we're in a fund that loans out to 17 different states and 2 U.S. territories. And we like to, lend out to investor-friendly states where the foreclosure process, if at all, we have to foreclose, then the process is quite seamless. And we typically loan 40 to 60% loan to value. But when it comes to an equity standpoint, same thing. We want to be in investor-friendly states, right? Kind of stay away. Like from a New York standpoint, would not invest in New York. Getting a landlord out or a tenant out sometimes could take 6 months to a year, right? Versus, in a Texas where it's much quicker. So you want to keep all this stuff in mind, but we really lean on our operating partners and the relationships that we have built with them to lean into really strong markets.
Yeah, I think that's really well said. Unfortunately, some of the beautiful places that many of our friends and family members live in aren't necessarily the best places to invest today. Specifically, I'm from the Silicon Valley Bay Area. You're obviously from the Northeast region. You live in New York City, I believe Chelsea area, if I'm not mistaken.
Yep.
And you might not want to own there, but you want to live there. Well, we want to play in a world and in a market and invest in a market where the rules for us and the tenants are mutually agreed upon, but also equal, meaning we shouldn't have the right just to, screw over a tenant and jack their rent up, mid-lease and kick them out because someone else can release it for hire. Well, similarly, why should someone be able to not pay rent and live there and squat in your property, right? So it's just a
Right.
two-way street and a mutual respect thing that we're seeking there, which you think should be straightforward and fair. However, there's some local political jurisdiction that may oversee that in some areas. So to each their own, I suppose. But even within, that kind of there, specifically in regions, you're obviously looking at a lot of Texas. Is there any specific strategy for the multifamily side of things that you're looking for? Whether it be affordable plays, deeper value adds, what kind of gets you and Chris excited to say yes to a project?
Yeah, great question as well. So we've seen a lot of value add plays. I think that's been very hot over the last 10 years, right? Essentially going in to an under optimized property, sprucing it up, cosmetically, really making a better place to live for the tenants. So you're able to increase rents by maybe $100 to $250 per month per unit, and that really drives the value in the NOI. So we're still, looking at properties like that. I think more specifically, our buy box is more around year built and year one cash flow and positive leverage. Those are really big levers that we want to see in the beginning, so we understand going into the project it's a strong property. So typically looking at 2,000 plus, we like to see 5% cash on cash in year one with positive leverage, which can be tough to find even right now with rates elevated the way they are. Now, got big news from Powell last week in Wyoming that we might have a rate cut here in September of 25. So there was a lot of excitement in the market. But you know, with that said, I think a lot of the rate cut could be potentially baked into the Treasury right now, and so going to 26, I think there's some really strong deals to be had. Like we mentioned earlier, there's some struggling operators and struggling deals where we're able to get into a really good basis and a really good project. And so that's what makes me most excited. But I think at the end of the day, you really want to look at the fundamentals of the property in itself and really understand what is the business plan associated with that property, and then the operator, right? Many times, the property's a horse and the operator's a jockey, right? And you're partnering with the operator to manage that operationally for the next 3 to 7 years. And what's the business plan that we have in place? And what's the current portfolio look like today? Like how are you managing your other properties? How is your portfolio doing? And we've seen operators within the markets that have, could potentially have deals in 21, 22 that are struggling pretty tough. But they could have other deals that are performing extremely well. So you want to make sure you're doing your due diligence on that. But that's typically what we look for in our due diligence process when talking to operators about the next deal we invest in.
Yeah, that all makes sense. And, we typically speaking like the newer vintage assets. There are sometimes we see deals that are too irresistible to pass up. However, that better be accounted for in the CapEx plans. And what that means by CapEx, it means basically dollars you raise, as you so well pointed out, the capital structuring of deals. You got your senior loan, you got your equity, and then you got reserves and, improvements to the property. So CapEx are basically improvements. So you just better have your business plan mirror and match if there is a older property, or at least get comfortable with the due diligence as to what perhaps the previous owner was doing to that property beforehand. But everything you said there, I fully agree with. And, value add, I think just something that we've been harping on a lot on our conversations with our investors, with our partners, is value add is a relative term. Value add really just means how do you increase NOI on a property. So what we've done historically is we've reduced property taxes, which gets you a really big bump with basically doing nothing but preemptive work, basically pre-closing work. Or you can do ancillary income items, things like that. I actually like the ancillary income item more if we know within our property that we've got, enough room to push income up. It happens to me all the time with the glare and the lighting. If you need the income items to be pushed up there, ancillary income is a really cool thing because oftentimes you're not spending more than $500,000 to, almost get about $120 rent bump on renewals and leasings and stuff. So stuff
Yeah.
like that, low hanging fruit items, we like a lot more than the traditional value add where you go turning over units, basically spending $10,000 to make, a $200 rent turnout, right? We've seen a lot of deals, actually. The ones that are going most belly up were those harder core value add deals because the juice wasn't able to get or you weren't able to squeeze the juice out to spend those dollars. So
Right.
we are looking for deals that you can create and get mid-teens IRR returns without actually having to swing hammers and put a ton of work in that respect. Are you also seeing that from what you're seeing? Because obviously with you and Chris being able to raise capital like you can, deals somehow find your inboxes, right? So are you seeing, what are you kind of generally seeing from sponsors right now from deals that are actually hitting the market? Because deals are pretty scarce right now, unfortunately.
Yeah, it's definitely been a slower year from what we've seen. But to your point, the tax abatement or tax strategy is a huge play if you can make it work within the jurisdiction and the state that you're investing in. We invested in a deal in Waco that had that exact strategy in January, and it's doing very well. And I know you guys do that strategy yourselves, which to your point, you avoid the manual cost of labor and the construction team going in and having to flip units, which is time intensive. You can have a lot of delays, permitting. You have to really flip tenants over between. You don't want to force turnover, so you do it as units turn. So there's a lot that goes into the old school value add versus if you can do the tax abatement strategy, then it's a quick win on the NOI for a much lighter lift. And so we love looking at deals like that. I know you guys have really specialized in doing those deals. So I always love when you send one across the inbox that has that.
Yeah, we'll be checking your inbox soon because something may or may not be there already, which I think we've been talking about. So, if you're an investor or fund manager looking to learn a bit more about a sneak peek opportunity on a unique tax exemption structure, yes, we are still able to do them, sparingly so. We are able to navigate and craft out a win-win-win structure there that's beneficial for the city, for the tenants, and obviously for our investors and such. With that said, As you go forward, what is the ultimate goal for you, Brian? Is your goal to kind of supplement your income through basically the market wave that we're going to ride up here and maybe kind of get out of tech sales there and basically be a landlord and capital raiser in a sense? What is your end all be all here? I guess a 5 year and 10 year goal here, if you've thought about that. Probably above and beyond becoming a father.
Yeah, thank you.
I have to
Yes,
imagine that's looming.
yes, it is looming. We are talking about it, Jenna and and I got married last May, so that's the grandparents are knocking our door down.
Hey, by the way,
Um,
I just want to say this right now. If you ever wanted to have a master class on how to do a world class honeymoon and Euro trip, I think this is the guy you need to consult because this guy literally went everywhere. I digress. I apologize.
yeah, it was a pretty fun trip to say the least. But
Yeah, I'm
yes,
sure Amex was happy about the bill.
we did them well. We did them well.
Yeah, yeah.
But yeah, that trip was amazing. And so we fast forward to having to pay that bill off and making money, which is investing in real estate. And so, yes, the plan would be, Salesforce has been amazing, right? And I talk to people all the time and I lean into the fact that I have a W-2, right? A lot of people ask me, like, how do you start and run 7B Capital, invest in deals, and still have the time to work, a full-time job at Salesforce? And, quite frankly, I work off hours, throughout the week to manage 7B Capital and to talk to people like you. Like, we're doing this on a Monday afternoon at 5:45, right? So like, we're doing this throughout the week and meeting with operators. But I leaned into the fact of having a W-2 because, one, it provides my income to continue to scale and invest into these deals. It provides the stability of the income checks, right? And the investments that I'm able to invest. But also, to your point, the benefits of having a kid over the next year or two and maybe two, right? And riding that wave out. But if I'm blessed enough to be able to continue to increase the passive income that I have now, to a point where now we're scaling our 7P Capital portfolio with our investors and doing rep, and then it's getting to a point where we want to manage the portfolio and really spend all of our time every single week managing rent or managing our investments, our investors. Then I can very much see us taking this full time. But that said, I really enjoy doing both right now. I lean into it. I lean into any tech investor who may be listening to this right now, or high income W-2 employee for that is working a job that's very demanding but doing very well for themselves, to reach out. And I'm more than happy to have a conversation because I think you can absolutely do both, and you can definitely dip your toes into commercial real estate investing or real estate investing in general, and to really see if this is the right path for you. Because once I got in, it becomes extremely addicting. You start to see those cash flows as distributions hit, right? Your equity grow, ownership and depreciation benefits that you have when you do your taxes every year. And so my journey is still very much being written. I mean, it's been 10 years. And I'm very happy with the 10-year growth, but I'm excited for what the next 20 to 30 years has, based on what I know now and the growth that, I've personally gone through, but also the growth that we've seen at 7B Capital in just a small 2 years.
Yeah, I'm very excited to see your journey on a personal level and then obviously family for our own business relationship, but also personal relationship, which is growing day by day, which I'm very proud to say that we're buddies, obviously, and friends. So, with that said, any parting advice you have for any investor or any listener right now that you would share that you haven't maybe mentioned so far, or anything you want to kind of harp on? So often people, give advice, but if Bryan Morris is giving you advice, it's frankly just better advice than the average individual. So the floor is yours. Is there any kind of 2 cents you'd give to your future self or anyone else who might be looking to graduate college or younger, or isn't maybe as established or as far as along as you are at the moment?
Yeah, I wouldn't go as far as saying that, but I mean, I have learned a lot of great tips along the way from what I've done, and quite frankly, what I have enjoyed that I've done well, but also some of the lessons that I've learned. And I think the old school mentality of putting everything in your 401k, maxing that out, and setting and forgetting it for 40 years and retiring at 65 is, I think it's an old school mentality. And I think that there's so many options in today's world with the technology that we have, the apps, having LinkedIn and social media and access to, quite frankly, everyone in the world because of our phones and the internet. There's ways that you can invest and manage your money yourself while you're working and while you're doing it that are beyond the traditional paths of what that 401k and Wall Street tells you. Because quite frankly, Wall Street wants to manage trillions and trillions of dollars because they get AUM fees and they make all the money on top of that. And that's why you see the JP Morgan Chase building that just went up in New York City. This just opened today, August 25th, and it's $3 billion. It's beautiful, and they're the biggest bank in the world, and I work with them. But they make so much money because they quite frankly manage so much money. And I think there's a way, if you can do some type of level of education, that there's ways you can manage your own investments along the way to live a fulfilling life while you're doing it and not waiting till you're 65, but also scale and grow your wealth in a very risk mitigated but safe and fun way along the way. Because like you mentioned, my wife and I very much enjoy going on trips. We enjoy traveling. We enjoy the fruits of our labor and, enjoying what we make, quite frankly, right now, and for our, future family. So I think if there's any advice for people coming out, it's think about it that way. And, with the internet today and you hear Gary Vee and other people, there's a million ways to make money. And I think some of those traditional ways are going out the window. So educate, read books. I mean, I think people are reading less and less because everyone's on, their phones or tablets or anything else nowadays. And the only reason I started getting into real estate investing was because I read Rich Dad Poor Dad when I was 22, and I'm so glad I did. But Psychology of Money, there's so many books too that are out there that can kind of shift your mindset. But I guess that's not necessarily just a real estate advice, but more so a financial advice as to how I see it.
No, I think that's even arguably better because it's kind of indicative that if you do read, if you educate yourself, if you do nourish yourself with podcasts, good information, and also, the other key thing I'll add onto that, which you'll obviously agree with, is just people, because different people get different results, and you show me your friends, I'll show you your future. In large
100%.
parts, obviously, there's exceptions to any rule, but by and large, that's how it is. So enrich yourself, level yourself up, and you will be happy. And fortunately, I will also say this: don't be afraid to spend some money as well and enjoy yourself, because the time we have on this earth is not granted. It's limited. It's finite. You're only so young before real responsibilities come. I've developed a very good knack and craft of spending money really well, just like yourself. So fortunately, I can make a buck pretty well, but I'm also
Yep.
really good at spending it. So don't be afraid to spend a little bit of money along the way.
I see you on the golf course a few times a week. I'm like, man,
Listen,
that guy's living the life out there in Scottsdale.
let me tell you something right now. I wake up at 6 a.m. I get my workout in. I usually actually do my first load of email works. I get that done and I carve out and make time. Granted, if you're someone who's got multiple kids, you're like, all right, yeah, buddy, sure. And yes, this will not last forever, but while it does, I'm going to milk it for all it's worth
Take
while
advantage of
still
it.
being, yeah, while still being responsible on the job. Brian, you've actually put out so much great stuff. Just wrapping up here, so much great, like I think like ebooks, kind of content information. Where can people reach out to you to kind of follow your blueprint, follow your success story, and just connect with you to learn more about you and Chris and the offerings that you guys have?
Yeah, I think I'm most active on LinkedIn. Bryan Morris on LinkedIn. You can find me there. I like to post, several times a week and stay active and share what I've been learning, quite frankly, over the last 10 years. And then 7pcapital.com, you can request an invitation to join our group. And essentially, it's just, you'll get an email from us and, info call where we're just going to meet each other and talk shop and see what your strategy is. And, you know, just want to meet more investors that are looking to invest into real estate and see if I can offer any piece of advice to do so. So I think LinkedIn, 7pcapital.com, or you can email me directly at Bryan at 7pcapital.com, and, I'll get back to you. And looking forward to, always networking. And, Craig, I appreciate the time, the dinner that we had out in Scottsdale where you guys always do hell of a job with events. I got to say that. And so
We
I
we, we
look
had
forward
we
to the
had
next time we're together.
Yeah, we had Seafood Tower Wars that night. I think I would actually argue that more seafood was left on the table at Ocean 44 than was ate, but sometimes you got to make a statement. So hopefully we left a lasting one there. Brian, thank you so much for being a great guest. I look forward to growing our relationship, watching your success. It's been a pleasure to get to know you to this point, and I look forward to the years beyond. For all those who are listening today, we're very grateful for your ears. We are looking forward to working with each and every one of you. Don't be a stranger. Feel free to reach out and say you listen to the podcast, or if you have any questions, information. Myself, I am always here for you. And obviously, if you have any questions for the man, Brian with 7P Capital, he's your guy. For everyone listening, we appreciate you, and we'll see you next week. Peace.